Friends, thank you once again for tuning in. This is your host, none other than Mr. Spotter Fred. Now, today's session, friends, we are going to introduce group accounts. We are going to introduce a consolidation, or rather we call it business combination. Now, friends, you need to remember that when we talk of consolidation, we talk of group accounts, we talk of business combination. These are topics that is not only in Section 3 financial reporting, but is also a topic that is in advanced financial reporting. Let's try to see the difference. In financial reporting, we'll talk about consolidation, or we'll talk about group accounts, whereby we are going to look at the subsidiary. We are one subsidiary to information. Then we talk about an associate. We talk about a joint venture. We also talk about a group cash flow. But when we come to the advanced financial reporting, we talk about group accounts, yes, but we go into details. We have to talk about, apart from the subsidiary, we also look at a sub-subsidiary, how the multi-structure business comes in. We also talk about apart from associate and a joint venture, we talk about disposal and acquisition of shares in a subsidiary. Those are disposal of shares, remember. Then it means that we also talk about now discontinued operations. That's accounting for a discontinued operation in respect to International Financial Reporting Standard number 5. Apart from that, we talk about the foreign subsidiaries where IS-21 comes in. Then we also talk about the group cash flow. The group cash flow that we talk about in advanced financial reporting is not the same as under financial reporting. Under financial reporting, we talk about the group cash flow where we talk about non-controlling interest adjustment and investment in an associate adjustment. But we come to advanced financial reporting, the group cash flow, we talk about not only non-controlling interest adjustment and investment in an associate adjustment, but we also talk about the acquisition and disposal of shares in a subsidiary. That's what we are going to look at. Now, when we talk of consolidation or business combination, this is where one company may acquire the shares of another company and will be required to prepare the consolidated financial statements, or you are required to prepare the combined financial statements, where you take the financial statements of one company and you bring or you adjust them or you combine them with the financial statements, meaning the assets and liabilities of the other company. And that only will exist between the group members. Now, we are saying that today we are talking about group accounts. We also call it consolidation. We also call it business combination. Cut. Kuna kitu nilikuwa nataka kuangalia hapo.
Tunasema consolidation.
Okay. Now, friends, remember, when you talk of consolidation or business combination or group accounts, we may have various companies, or one company may have acquired another company some time back. So we have many companies in other various places, and they operate through a central administration. So when that happens, when one company acquires the shares of the other company, or when one company controls or has some ownership to some extent in another company, then we should be required to present or prepare consolidated financial statements. According to IS-27, we may look at the separate financial statements first. Then after preparing the separate financial statements, then according to IFRS number 10, we now prepare the consolidated financial statements. Now, friends, you need to remember, some of the standards we'll be looking at, in the process of consolidation will be one, there is IAS 27, there is IFRS 10, there is IAS 28, there is IFRS 11, there is IFRS 12, there is IFRS 3, not forgetting we have IFRS 11, that's okay, not forgetting IFRS 5. In the process of consolidation or business combination, we will find ourselves trying to introduce some of these items to a certain extent. For financial reporting, we will not want to talk about it in details. We'll introduce a few. But for advanced financial reporting, we'll be forced to talk about our International Financial Reporting Standards number 3 and International Financial Reporting Standard number 5. When we talk of IAS number 27, remember, we are looking at the separate preparation of the separate financial statements, the preparation of the separate financial statements. When we talk of IFRS 10, we are looking at the consolidated financial statements. Now, don't forget that under IAS 27, the term control is basic voting rights. Under IAS 27, meaning that if one company has more than 50% of the voting rights of the other, then that becomes a subsidiary. But when it comes to IFRS number 10, control does not only mean the voting rights. Control does not only mean the voting rights, but can also include power over the other company. So in that case, you can go to our website and access our text. You realize we have the expanded explanation of IFRS number 10. So IFRS number 10 that came the other day, it was in fact of 2014. You realize that you don't look at control as only the voting rights, but we may have further than that. We may have where you have less than 50% voting rights or shareholding, but you still have control over that. So in that case, we have IFRS number 10. Then IAS number 28, that is accounting for investment in an associate, accounting for investment in an associate, whereby you have less than 50% shareholding but more than 20%. And according to IFRS number 10, it does not qualify to be a subsidiary. If it does not qualify to be a subsidiary according to IFRS number 10, then that becomes an associate. Don't forget that. Then IFRS 11, this is accounting for joint arrangements, accounting for joint arrangements. Initially, remember, we used to talk about IAS number 31, but IAS number 31 is no more there now. We are looking at IFRS 11, joint arrangements, where we are classifying the types of joint arrangements into two. That is the joint operations and secondly, the joint venture. But under IAS 31, friends, remember, we were talking about the joint, the joint operations, the jointly controlled assets, and the jointly controlled entities. There were three. But now under IFRS number 11, we only talk about joint operations and a joint venture. We are going to look at that. Then IFRS number 12, we have the disclosure requirements. Remember, disclosure requirements is in respect to not only to the separate financial statements, but also the consolidated financial statements, and also the investment in an associate IAS 28, and also the IFRS number 11, that's accounting for joint arrangements. So disclosure requirement, what are you required to disclose in the financial statements for for better understanding of the financial statements. IFRS number 3, this is business combination. The business combination in respect to goodwill. In respect to goodwill, we really look at mainly goodwill. How do you account for goodwill? According to IFRS number 3, friends, goodwill will be accounted either using two methods. One, we have the fair value method. Two, we have the full method. We have the fair value method and we have the partial method. Under partial method is where we are only going to recognize goodwill attributable to the holding company only. While under fair value or full method, we are only going to determine goodwill, not only goodwill attributable to the holding company, but goodwill as well attributable to NCI in respect to, or rather on acquisition of a subsidiary. That's important. Then IFRS number 5. IFRS number 5 talks about accounting for assets, held for sale, and discontinued operations, So those are some of the items we'll be looking at, friends. Those are some of the items we'll be looking at. Now, today we want, apart from just looking at the overview, today we want to discuss these some of the we talk about definitions, or rather, let me talk about accounting for a subsidiary. Accounting for a subsidiary. Accounting for a subsidiary in the books. One of, when we say a subsidiary, we have not only, according to IFRS number 10, not only that we have more than 50% voting rights. That is not only qualification to make it a subsidiary. We can have less than 50% shareholding, but we still have power. If we have power and any other contractual agreements, then that other company we've acquired will be a subsidiary. Now, friends, remember, when we say about a subsidiary, one company will be a subsidiary of the other. According to IFRS, we say a subsidiary. According to IFRS number 10, according to IFRS 10, one company will be a subsidiary of the other only if they have power. No, there are three things. One, power over the other. One company will be apparent, and the other a subsidiary. If the parent has the following: one, power over the investee. The investee company, or the other company, now we are saying the second company, can be controlled. That is, there is power. There is exposure or rights. Exposure or rights over the investee. 3, ability to use power to influence variable returns. So one company will be a subsidiary of the other if this exists. So you realize that according to IFRS number 10, a subsidiary is not a subsidiary because of voting rights more than 50%. No. but because of also de facto power. You know, when you say de facto power or control, that you may have less than 50% shareholding in another company, but that other company is still a subsidiary because of the de facto, that is de facto control. We call it de facto control. And there are so many other things that we may not want to talk about now in respect to IFRS number 10, that you can get them from the standard, because that's a very wide standard, don't forget in that. So in that case, we have talked about a subsidiary. We may also talk about the parent. The parent is the company that owns or acquires the company that controls one or more companies. One or more companies. Then you also need to remember, friends, we have what refer to non-controlling interests. In summary, non-controlling interest is whereby a subsidiary has been acquired less than 100%. If it has been acquired less than 100%, then the remaining balance will be owned by outsiders, and these outsiders will be known as non-controlling interest shareholders. We are going to look at that. This is owns the remaining balance of shares in a subsidiary. That's it. So we have talked about subsidiary, we have talked about the parent, we have talked about non-controlling interest, and many other items we'll be talking about as time goes by. Now, when you are, accounting for consolidation, you need to remember that there is IFRS number 3, which brings out the provisions of the business combination. In this IFRS number 3, you will also encounter the element of acquisition where you need to determine goodwill. Now, goodwill, according to IFRS number 3, IFRS number 3, there are two methods used. There are two methods used in accounting for goodwill. One of the methods used is fair value or full or market value method. Under market value method, we determine goodwill not only attributable to the holding company on acquisition of a subsidiary, but also goodwill attributable to NCI or non-controlling interest shareholders on acquisition of a subsidiary. So that is fair value method. We have the partial method. Partial method can also be referred to as proportion method. Under proportion method, friends, we are going to determine goodwill not only goodwill attributable to the holding company only on acquisition of a subsidiary. That is partial proportion method. So don't forget that. We are going to come back to it again. We explain it in details. We'll talk about the fair value, we'll talk about the partial method in respect to determining of goodwill. You also need to remember that according to IFRS number 3, for the purpose of applying the acquisition method in IFRS number 3, we need to identify the acquirer. Then we need to recognize and measure goodwill. Then we need to determine, the acquisition date. we also need to recognize and measure the assets and liabilities and non-controlling interest. Those are some of the items. According to IFRS number 3, don't forget to talk about the acquisition date. Don't forget to identify the acquirer. Don't forget to identify the consolidation of assets, the assets and liabilities to be combined, and also as well non-controlling interest. Don't also forget to talk about the element of measurement of goodwill. And this is what we have just said in brief. We are going to come back to that. Now, we'll want to look at if you are consolidating a subsidiary. Let's try to introduce this maybe with an example. We'll look at a simple example and see how to prepare a consolidated financial statements in respect to the holding company and a subsidiary. We'll assume an example. We'll come and say, just before we go further, let's see preparation of a group statement of financial position. Let's look at group statement of financial position. We can call this GSFP, or we call it consolidated statement of financial position. How do we prepare a consolidated financial position, or a consolidated balance sheet, or a group statement of financial position, or a group balance sheet? How do we prepare that? There are some items that you need to remember. When we have acquired, in respect to IFRS number 3, when we acquired, we pay a purchase consideration. So there is purchase consideration, purchase consideration. Or the cost of investment. The cost of investment on acquisition of a subsidiary. If you are to acquire a company, you need to pay a consideration for that. You either pay it in cash or you pay it by a share-for-share exchange. Now, the difference between the purchase consideration and the net assets you have acquired is simply goodwill. Now, this goodwill may be negative or positive goodwill. So don't forget that. We'll talk about goodwill again and again. So we talk about, if you take the purchase consideration, the amount paid, you subtract the net assets acquired, what you get there is goodwill. Now, friends, don't forget that this goodwill may either be a negative or a positive goodwill. Now, how do we account for this purchase consideration, or this the cost of investment? When you are to purchase, we can say on purchase, on acquisition date, in the books of the holding company, we debit the cost of investment account, investment in subsidiary account. Then we credit. We either purchase it through by cash, we normally credit bank, or if it's share for share exchange, we credit our own share capital. Remember, I'm saying if we paid the purchase consideration by cash, you simply debit your investment in a subsidiary, you credit to a bank account. But if the purchase consideration was by share for share exchange, then we simply debit our investment in the subsidiary, we credit our own share capital. Now, don't forget, friends, we may have issued shares as a purchase consideration at a premium. If we issue shares as a purchase consideration at a premium, then don't forget, we are going to debit the investment in subsidiary. We credit our ownership capital at the par value. We credit the share premium. Now, friends, don't forget that because it's very, very important. One thing you need to remember, some of these may have been accounted for. As we are going to see some of these questions, they may have been accounted for. The purchase consideration must have been accounted for. For example, if it had accounted for, then this what must have been done. So your business will be so easy. You just need to use the purchase consideration or the cost of investment to determine the goodwill, and that's all. But if this was never done, it was never recognized in the books, meaning they paid the purchase consideration, but they didn't account for that in the books of account. So you need to recognize this accordingly. You need to debit the investment, the cost of investment, that's an non-current asset. You credit your bank or your ownership capital and share premium in the books of the holding company. Now, friends, you need also to remember that the net assets acquired. When you talk of the net assets, we simply look at assets minus liabilities. So I'll come and say, when you talk of net assets, when you talk of net assets, friends, when you talk of net assets, we are simply looking at assets minus liabilities. We are simply talking about assets minus liabilities. But you need to remember that we'll want to determine the net assets at the date of acquisition. When we talk about the net assets at the date of acquisition, on acquisition date, then we need to get the assets on acquisition date and liabilities on acquisition date. That may not be possible. We may not be able to identify the assets minus liabilities at the date of acquisition. It may not be possible in some circumstances. This means that when you are going to prepare the consolidated financial statements, you may be given the separate financial statements according to IS number 27. You may be given the separate financial statements at the date of consolidation. You need to remember that the assets at the date of consolidation are not the same as the assets at the date of acquisition. So to get it right, in that case, we don't use the assets and liabilities. Instead, we use the capital and reserves. You need to remember that in this case, this is the same as saying capital and reserves is the same now. When you talk about assets minus liabilities is equals to capital and reserves, that's something that you must have learned. So this means that if you have acquired you have acquired shares, acquisition of owner shares, acquisition of ordinary shares of owner shares also means acquisition of reserves, e.g., we talk about the share premium, we talk about the revaluation reserve, we talk about the revaluation reserves, we talk about the retained earnings, we talk about the share retained earnings, capital reserves, capital reserves, and other reserves. So that's what you need to remember. An acquisition of ownership capital, it also means that we have acquired all these other reserves because reserves belong to ordinary shareholders. If, for example, I've acquired 100% of the net assets, In other words, it means that I've acquired 100% of ownership capital, I've acquired 100% of the share premium, I've acquired 100% of the revaluation, I've acquired 100% of the retained earnings, I've acquired 100% of the capital reserves, and we have acquired 100% of the other reserves. That's what simply it means. Then now, you need to also remember that if you have acquired that, the group may have acquired 80%, then the balance 20% will be owned by outsiders known as non-controlling interests. We are going to talk about that in a moment. So simply in preparation of a group statement of financial position, we have just simply introduced how do we determine our goodwill. But we have not gone into details according to IFRS number 3 in respect to measurement. We have also talked about how do we recognize, how do we account or recognize it in the books of the holding company. That's the purchase consideration, and how we pay, how do we recognize it in the books, and how do we identify the net assets acquired. That's what we have said. And what are these net assets? We have simply said that. Now, our next, we need to look at an example where we have acquired 100% ownership capital, or we have acquired 100% net assets of the subsidiary. So we look at an example. We know we want to know how, or to learn how to prepare a group statement of financial position. So we come to our first example. Say example 1. We want to look at a case where, let me even call it case 1, a case where, or an example where we acquire 100%. The holding company, I'm saying we, or rather the holding company, where the holding company acquires or holds or owns 100% net assets in the subsidiary. Now, friends, in this case, it means that we own 100%. There is no outsider. We don't have non-controlling interest. We own 100% of the shares in this company. So what are we going to do? First, let's try to give the financial statements, then we see how to consolidate. We come and say, H acquired, H Limited, let me use the H Limited. H Limited acquired 100% net assets, let me say ordinary shares, on 31st December 2015. The following are the balance sheet, are the statement of financial position, are the separate financial statements as at 31st December 2015. Now, friends, you need to look at that we acquired, H acquired 100% of S, and it acquired on 31st December 2015. We have been given the balance sheet as at 31st December 2015, and we need to consolidate on that 1st December 2015.